What is going on, everybody? Welcome back to the Capitalized Podcast. I'm Chris Casella, and as always, I'm here with Grant Smith. This episode is brought to you by our private lending company, Sharper Capital Partners. If you want to learn more about how Sharper Capital can help you build your real estate investing business, you can check us out at sharpercapitalpartners.com. For those of you who are watching this, I don't know if you can tell, but we are in a bit of a different location. We have moved to our new office space, and we are in a very small studio, and I would turn the camera around so that you could see our setup, but it's too delicate the way that we have it right now. So we're just getting used to this space, and hopefully future episodes will have a little bit higher video quality. But more important thing here is today we're going to hop on and talk about the difference between investing our money in hard money loans, which is what we've talked about extensively on this podcast and amongst one another, and investing in real estate deals. So buying properties. That's something that Grant and I have started doing more of recently, and we plan on doing a lot more of in the coming years as well. And we just kind of wanted to talk about the pros and cons of investing in both, what it looks like from our end, maybe even some of the logistics, and just have that conversation. I think there's a lot to talk about there. And as I usually do, I'm gonna let Grant start this conversation, and we're gonna just keep it going. This is, like many of our conversations, can go in a lot of different directions, but I'm excited to talk about this one.
Yeah, so this conversation really came up for me personally after we talked to a gentleman named Slocum Reed. And if you don't know Slocum, he probably will watch at least the first 2 minutes of this video and appreciate the shout out. But we were talking to Slocum, and he was talking about investments he'd made in good areas, areas that benefited significantly from increased property values over the last 10 years. And he commented saying the one thing that he really liked about investing in real estate is that he was still benefiting and reaping the rewards of good decisions he made 10 years ago. Comparatively to the hard money lending business, just like any business, it's also applicable because obviously you're laying foundation and developing a market for yourself. But it's not exactly the same because we're constantly funding down new borrowers that enter and exit the market. We got to always try to make sure that we're keeping in line with what the competition's doing. And I guess that's true from a property management standpoint and making your properties up to date. It's not like it's completely passive, but the benefit is once you make one good decision in investing in real estate or find a good piece of collateral that you're investing in, and it benefits you for a very long period of time, as opposed to having to go out and find, another borrower or another property to interact with. Chris brought up recently, he's like, what if we took the same amount of time in underwriting these deals for our clients as we did for underwriting our own deals? And that really jumped out too, because it's, we really do underwrite all the deals that we loan on as if we were going to be taking them on ourselves. We're getting broker price opinions. We're really diving into all the nitty gritty details to make sure that there aren't any hiccups with the loans, and that they're good loans for our clients too. So, in reality, it's like, okay, if we can find assets that generate similar returns on the capital that we're leaving in the deals that we're financing, then it makes sense to take a portion of the capital base that we're lending out and use that for acquiring properties, leaving them in deals. And so an example of that would be, we're lending out at 2 points and 12%, 3 points and 12%, somewhere in that vicinity. And so it's like, okay, on an annualized basis, if you're making 14 to 15% cash on your money, and that's ordinary income. But if you're making a return like that, then it makes sense if you can find a property that, net of all accruals and net of all expenses associated with it, let's say you have $10,000 you leave in the deal and it produces a $1,500 net cash on cash return at the end of the day. Well, that $10,000 in our mind is money well spent left in a deal, as opposed to just leaving it in a hard money loan. Obviously, it's probably going to be closer to a true 15% rate of return because of all the tax benefits that real estate provides. But in addition to that, there's the benefit of, you're getting appreciation in a property, you're paying down your principal mortgage, and it really just has a lot of benefits to reoccurring revenue. So that was my initial thought to this conversation. Chris, I'm going to pass it back to you, and you can share some of your insight here.
Yeah, I mean, first and foremost, I agree with everything you said. Obviously, we have this conversation a lot, but now we're having it publicly. And, last night, as an example, I spent a decent amount of time on the phone with a potential client, and we walked through every single potential possibility for her deal, right? Whether she was going to flip it, we walked through every single charge that she was going to have, like every cost that she was going to be associated with this deal, how much margin there actually was. We even calculated best expected and worst case scenarios, and we spent a lot of time chatting about that. And then we thought to ourselves, okay, well, worst case, if you can't sell this because she wants to sell it as a flip, if you can't sell this thing and you had to hold on to it as rental, would it service its debt? What kind of cash flow would you be looking at? And we just literally went through all the different minutia. And I was kind of like, I'm happy to do that. And I actually love doing that for real estate. I think it's fun. Like, I love analyzing deals in general. But that sort of conversation, just as an example, was, that's what sparked my interest when I was like, okay, well, if we just spent even, half this time analyzing our own deals, even if we were to buy very slowly and get like one property every quarter or something like that, then it would benefit us tremendously. And it's something that Grant and I have talked about ad nauseum, really, since even college, going back before Sharper Capital was even a general idea. And I think really what we're doing with the hard money space. So obviously, there's a big difference between hard money and real estate investing. In terms of the timeline that you benefit from doing the work. But there's also this interesting dynamic where, as a hard money lender, obviously you can sit at your computer in theory and you can write a hard money loan. You can wire the funds, you can have the conversations, you can do most of the underwriting. You can even just send somebody out there to walk the property for you. You could just write a hard money loan without ever getting out of your seat. And the deal will move forward and hopefully go all the way to completion without you ever having to lift a finger. And so you're getting rewarded in a different way when you write a hard money loan. And that is just in terms of, like, the way that I look at it is the amount of energy you have to put into a deal. And so I think you're kind of rewarded proportionately. Whereas, and then they manage the deal. Whoever you're lending to manages the deal. They oversee all the contractors. They are hopefully going to the property and checking up on it, making sure that everything's happening. They are doing the numbers. So somebody else it's a form of leverage, right? Somebody else is making this deal actually happen, and you are providing the source of capital to allow them to move forward. Whereas, you have to be the one when you're buying the deal. We're just flipping seats, right? Let's say we're borrowing money from a private lender, or we're deploying our own cash. Then all of a sudden, we're the one walking the property. We're the one managing the contractors. We're the one in the spreadsheet, making sure everything stays on track, and checking in to make sure that project gets to the finish line. And then you're rewarded proportionately for that as well, right? Now, there's that portion of the long-term buy and hold where, depending on if you have property management, you might have to be a little bit more involved in that. We underwrite all of our deals, just as kind of a side note, with property management baked in. So we have, vacancy, we have utilities, CapEx, repairs and maintenance, et cetera. Then we also always have a line item for property management, because our long-term goal is not to be taking tenant phone calls on the weekends and, fixing toilets or doing whatever other stigma there is around, like, being a landlord. We want to outsource all that. And we really want to just make the deals happen and do the value add piece and making sure that we're making good decisions on which properties to buy. So, long-winded way of saying there's pros and cons to both sides of the hard money lending piece, and also being the real estate investor yourself. And I think you are rewarded proportionately for each of those, whether that's in the actual return itself or whether it's in the amount of time you get that return, is maybe a little bit more gray, but that's kind of the way that I think about it.
Yeah, and we spent a lot of time today, not just talking about, why we're making this jump, but really the tangibles of what projects are we going to be pulling the trigger on. And I want to reiterate a note, like, we talked about, okay, maybe not growing. We're not trying to grow crazy fast, or potentially not trying, we had this idea of, okay, we will just acquire property a quarter. That could be very fast for some people. So that by no means is that like, if you're chipping away at a property a quarter, that's, I think that's great, crushing it, depending on what your situation is. For us, in our situation, one of the things that we inherited from the current business plan that we have at Sharper Capital Partners is we have a ton of relationships. So the components of our potential buy and hold strategy are the relationships that we have. Just the access to all these different contractors, all of these different lenders that we've seen perform for our clients on the back end, we have a really good base of connections that we can draw on. And so we feel relatively secure as opposed to just lending on a project. And one of the things that Chris brought up that I thought was just brilliant was how much control do we have over the deals that we lend on? It's pretty limited. We basically, the terms of the loan are pretty much where all of our where most of our risk mitigation goes into play. How much we're going to loan out, who we loan out to, what products we loan on. And those are kind of the big three, right? But from a real estate investor's perspective, the risk mitigation is more involved, but you do have more control, right? Because you're managing the contractors, you're managing the refinance process, you're managing the initial capital raise, however you're getting funds to procure the deal. And that's honestly one of the other things that's been a big benefit to what we do at what we're going to be doing on the real estate acquisition side is that, we have a lot of relationships with private investors at this point who we've been able to put into our hard money loan deals. And now, capital raise is going to be not easy, but it's going to be a component of our operation going forward that allows us to continue to scale. And so we're pretty bullish on, what we're going to be able to do this year. But more importantly, I think one of the things that we did earlier, and it was the initial point I was getting at, was that we really got specific this morning with what exactly we were trying to take down and what a good deal looks like for us. And something that we've just seen time and again. And we're getting experience with two different markets, but I'll highlight on this side of it. Really, the trifecta, right? Even if we have to leave money in a deal, we're okay with that, so long as we get cash flow, or at least enough cash flow to service debt well and not require a capital call in the future, where we basically have to lay out more money than the reserves that are being built up in the operating account for the properties that we acquire. Just to make sure from a cash flow perspective, we're not getting constrained on the properties we buy. But we really want solid properties in great areas that are going to appreciate over, the next 10, 20, 30 years. Pretty much everything we're doing at Sharper Capital Partners and any of the businesses that we've started really is about playing an extremely long game and adding as much value. In this case, it'll be to the community and to the tenants that rent those facilities, but it'll also be to the people who are going to be selling these properties to us, and we'll be managing them for a long time and taking great care of their assets and making sure that we're contributing to the greater Cincinnati community and providing great housing. And so all of those things considered, the criteria that we really hit on, and Chris will probably reiterate them in a better way, more organized, but we're essentially looking for properties in areas on the east side of Cincinnati that we understand and know are going to appreciate well. Properties that, even if we have to leave good portions of money in the deal, if we can achieve a 15% cash on cash return, we're very happy. And that's a great use of capital. And we want to buy the biggest units we can. I mean, in reality, it's like, it makes sense if you can deploy, $600K at a whip, it makes more sense to do that than to try to piece it together with 6 $100K properties. So I'll pass it back to Chris, but those are some of the key points we're hitting on when we're thinking about what we're actually trying to buy.
Yeah, no, I think you laid it out well. And I think really the strategy for us is something that, again, we talk about this a lot, but we're playing a long-term game, right? I mean, there is a short-term benefit to investing in some of the properties that we've talked about before, in the Middletown areas, which are a little bit lower end, but higher cash flow, and still doing the best we can to make sure that we're providing quality places to live for these tenants and attracting the best tenants possible. But just overall, I mean, when you think about a property in Middletown versus a property in Hyde Park or Oakley or somewhere on the east side of town, it's just a different demographic. It's a different type of property, and it's a different demographic who's going to be renting that property. And over the long term, is that property in Middletown going to appreciate as much as a property in Hyde Park? It's just probably not going to, right? You might get a higher cash flow because you can get somewhat similar rents, not the exact same, but somewhat similar rents for a way cheaper property. But then, Grant, you brought up this point about capital calls, and just to clarify for anybody who's listening, what we mean by that is some sort of outlay of cash throughout the course of our ownership of the property, whether it's replacing a hot water heater or having to, turn over a unit for a new tenant. So any sort of like capital call or cash outlay throughout the course of ownership. Now, the way that I think about this, especially when it comes to a different demographic in a different area of town, is you can fix up a property as much as you want in Middletown, and there's a high likelihood that you're going to have to outlay cash in 3 or 5 years, just because the tenants who live in Middletown, and this is a very general statement, and obviously there's nuance to this, but as a like on average, the tenants who are going to be living in a Middletown property are going to potentially treat these places a little bit differently than somebody who's in Hyde Park, who's living in a, $500,000 house or whatever it might be. So you can go in and do a complete renovation on a property in Middletown and still have to do a capital outlay in 3 to 5 years. Whereas you could potentially buy a property in Hyde Park that is maybe a little bit dated and rent ready, and then rent that thing out for 5 years and not have a capital call because the people who are living there just might take better care of it. Again, very general statement here, not always true, but on average, when you see a higher class neighborhood, it's just going to be the case. So, it might be hard to or impossible to avoid a capital call in general or for any of our projects, but just minimizing that as much as possible, because we were looking at a 2-unit in Hyde Park earlier today, like right before we hopped on this call, and it's not super nice, but it's in great condition. Like, it's not updated. It doesn't have granite countertops, doesn't have LVP, but it's got hardwood flooring. It's got laminate countertops that are in great condition. The property's just been taken care of very nicely by both the tenants and the owner. And so I wouldn't be upset owning that property and then potentially having to renovate it a few years in the future, knowing that we could get good rents for, 3 to 5 years or whatever that timeline ends up being. And then looking at the kind of appreciation that you're going to get in that property over the course of 20, 30, 40, 50, however long we live, years. So anyways, just kind of a side note that I wanted to hit on when you mentioned the capital call, Grant. But when it comes to criteria, I think you outlaid it, really well. We want to invest in nice areas that we wouldn't mind living ourselves. We want the appreciation from that. And we do have a certain sort of cash on cash return, just like any investor, that we want to get from the capital that we leave in the deal. And hopefully, you can invest and leave no money in the deal. I think that's more likely to happen in somewhere like a Middletown versus probably having to leave, 5,000, 10,000, 20,000, whatever it might be, into a deal in Hyde Park. But in both of those cases, I'm happy for different reasons.
Yeah, so there's a lot of directions we could take this conversation in, but one of the ones that I wanted to hit on was we have a lot of opportunity to scale pretty quickly right now. And in the ideal situation, we're able to take our entire capital base that is inside of our hard money loan portfolio, and deploy as much of that as possible at the right rate of return into owning real estate. And I want to hit on that point because I think it might be beneficial for really anyone who is deciding between asset classes, because most people just think of real estate as, if you're listening to this and you're a real estate investor, right, then your first thought is going to be real estate. But there's always an opportunity cost to your capital. And for us, like I said earlier, that's 15% on our money. And we're willing to trade that 15% on our money because we have to earn every single loan and every single borrower and every single project that takes out that capital and trade it into an asset class for the same rate of return. But ideally, very conservative underwriting allows us to earn that 15% rate of return for ideally ever, for a very, very, very long period of time. This is one of those situations for myself personally where I go, okay, so what changes in the dynamic of the way that we currently run our operation at Sharper Capital? And it literally just means that we raise more OPM to fund our hard money loans. It's not that big of an ask, and people are very eager to deploy their capital into hard money loans. People love collateral-based lending, and a lot of people use their self-directed IRAs to put their retirement funds to work at a good rate of return where there's, they're not paying taxes on that money, right? Because it's in a self-directed IRA. So the structure for Sharper Capital Partners really doesn't change that much other than the capital base, which is we're going to be using more private money in our hard money lending operation, and in turn using more capital in our just more cash, I should say, in our real estate acquisition space. The other thing that I think is worth noting is that we are not opposed at all to using our type of lending on projects that we will be taking on in the future. We understand hard money, and there are projects out there that are absolutely screaming deals, and they certainly warrant borrowing money at an annualized 14, 15, 16%. There are deals out there that warrant borrowing money at 20%. And it might sound crazy, but it does exist. And there are a number of ways that you can use hard money lenders, a number of ways that you can use really private capital to amplify your returns and expand your portfolio much faster than just using your own cash. So we talk about moving to an all cash position for the holding company, but realistically, that's just the cash we're leaving in the deals, right? We can't leave. If you're going to leave OPM in your deal, it really is got to be like some sort of partnership, or, obviously I'm not like a legal or security or tax professional, so don't quote me on this, but that's when you're leaving OPM in a deal, that's kind of where you toe the line of, what would you call those, syndications or, anything to that effect, which is not our direction initially. We want to own as much with our own hard-earned dollars as possible. And we think that we're going to be able to use leverage because we've literally been, educating people on how to use our capital to leverage and crush their deals. And they have been, and it's been super rewarding. And now we're going to get to practice a little bit about what we've been preaching for so long. And I'm just absolutely excited for it because we see investors all the time taking down deals where, they're borrowing money from us at 14, 15%. And I say 14, 15% because, 2 points and 12%, 14%, or 3 points and 12%, 15%. But I bring this up because, people might say, oh my gosh, that's so expensive. But when these people are out there fishing for deals full time and they're finding projects that more than support this type of financing, and it makes perfect sense. It's ridiculous what some of these investors are doing with their cash out refinances and getting more money out of the property they put into them and using that to go acquire more real estate. I mean, we have one client who literally built $6 million in real estate, or acquired $6 million in real estate just by doing that. And basically, he's basically a printing press with other people's money. It's very impressive. Not saying that that's the direction we're going, because we're happy to leave money in deals, more than happy at the right rate of return. But I think it's going to be a great case study because we understand these products so well, and at the same time, we're going to be able to basically go end to end from our business, from sourcing deals, financing them, and then putting them into a holding portfolio. So I'm stoked about it. I know Chris is too, but I just couldn't be more excited about what we got going on.
Yeah, I'm super excited. And I think really the last point I want to make here, for risk of sounding like a broken record, because I definitely do bring this up a lot, but I bring it up because I think it's important. But more than happy to borrow money for our deals to make them happen. There are certainly deals that warrant a high rate, high interest rate, because they have such a high rate of return and their long-term benefits far outweigh the short-term costs. One thing that I think about a lot is, okay, well, on the back end, and Grant has touched on this a lot, we're happy to leave money in the deals because we don't necessarily have to refinance to get every single penny, right? So we can leave some money in the deals. We have worked hard to be able to afford that luxury of being able to leave money in the deals and still be able to do new deals. Now, there's an argument to be made that you should refinance and take every single dollar out because that's tax-free money that you can use to go acquire more deals, just like the example, the client that Grant was talking about before. There's another argument to be made that says, and this is kind of the camp that I live in, listen, if you have the luxury to be able to leave money in deals and still be able to have cash available to go and buy new properties, why wouldn't you just take really kind of the minimum amount of leverage that you need to take on the back end to get as much of your money possible out, as much money as possible out, while still maintaining a really healthy amount of leverage, right? And healthy will be different for everybody, right? Everybody's situation might be a little bit different. But for me, that's like, if I don't have to take 80% LTV on a cash out refi, or a rate and term refi, then I will not take 80%. I'll take 70%. on a cash out, or I'll take 75 or whatever it might be, just a little bit lower leverage. Because you think about when you're scaling a portfolio, 5% might not sound like a whole lot, but 5% across 50 deals or 100 deals makes a huge difference. And if it's between 80 and 70 or 70 and 60, you're talking about 10, 20% of leverage that you're scaling back. And not only does that increase your cash flow, which is a huge benefit, right? I mean, you're leaving more cash in the deal. Not everybody has the luxury to be able to do that and also scale. But if you do, you're getting higher cash flow and you're lowering your risk over the long term. Because one thing that I'm acutely aware of, I'm 26 right now. I lived through 2008, but I did not invest through 2008. But markets change, right? Just because this is, I think, Ray Dalio, but he's like, just because it hasn't happened in your lifetime doesn't mean it won't ever happen at all. And I'd almost argue that just because it hasn't happened in your lifetime, history has a tendency to repeat itself, just like human nature does. I would almost argue that it's more likely to happen because it hasn't happened in your lifetime. And so I'm acutely aware of that. And I'm always thinking about, okay, well, as you scale your portfolio, leverage is super powerful. And it's a tool that we are huge advocates of, done correctly and done safely. Obviously, it's the business that we're in. And then on the back end, if you can keep your entire portfolio at a lower amount of leverage, if you have that luxury, then that's something that I highly advocate for as well. I just wanted to bring that point up because it's one that Grant and I talk about a lot. And again, we talk about it in private, but I like talking about it publicly because it's a conversation that I think is worth having if you're at all involved in real estate. So that's my final point. Grant, I want to give you the chance to say anything else you like here before we wrap it up.
No, I'm so glad you hit on that point, Chris, because in reality, like we had this conversation earlier, it's like, okay, well, how much money are we comfortable leaving in the deal? And the truth of it is, like, if I can, the same deal that if I can refinance a deal and only leave $20,000 in and I earn a 25% rate of return, well, then maybe I leave $70,000 in the deal and earn a 15% rate of return. Again, those numbers aren't scripted or coming from anywhere in specific, but just more so like an example, kind of on the measure of we aren't out here to chase the highest rate of return. We have a benchmark of return that we're looking to hit to make sure that our capital is being used effectively and appropriately. And we want to try to get that in as many real estate deals as quickly as we can. And so at lower leverage is even a sweeter thing because at the end of the day, this isn't a perfectly straight path to wealth creation. There are bumps in the road. And I think that the general trajectory for real estate prices in the US is pretty long, and I'm pretty bullish on it, or else we wouldn't be buying real estate for appreciation purposes in addition to cash flow. But at the same time, we're very comfortable taking a lower rate of return to secure ourselves against the loans against these properties. And I think that also just opens up a number of opportunities in the future. Again, I go back to like the creative side of finance. Whether or not you've done this in the past or you even are aware of it, cross collateralization is a very powerful tool, and it's not something that you want to employ lightly, but it's something that you can employ against your dormant equity to make an acquisition when you otherwise might not be able to. And that cross collateralization, right, is basically using equity you have in an existing property as a down payment for the purchase of a new property. Hard money lenders finance this stuff all the time. Not all of them do, but the ones who do, it's a core component of their business. It's a core component of our business and what we do. And all I can really say to that is, having equity, even if it's dormant equity, because I think so many people get caught up on what's your return on equity, you're leaving too much money in the deal. In reality, my thought process on that is your equity doesn't have to be dormant. You can use that equity any way you choose. You really just want to make sure that you're comfortable sleeping at night, because at the end of the day, and this is, business isn't perfectly mathematic, and there's a personal side to it as well, especially on the investment side. And so when it comes to making decisions about how much risk you want to take, and the more leverage you have, the more risk you're taking. That's just the truth of it. And we want to be able in a very comfortable position where if things move sideways, we have plenty of room to ride it out. And that's an essential component to really anyone who wants to play a long-term game in any asset class is, how can I be around 20, 30 years from now? And if you are, you're probably going to be thriving. But that's all I got, Chris. Why don't you get us out of here? And, we'll see you guys in the next one.
Awesome. Yeah, that's all we got for you today. If you guys found this conversation helpful, please share it with a friend and leave a review. Give us feedback on how we can do better and what kind of stuff you want to hear us talk about in the future. I'm happy to take one thing that we haven't talked about, but I do like this model. If you guys have questions that you want to see discussed on this podcast, or even in the Facebook group that we just started, which we'll leave a link to down below, let us know or reach out to us. We'll leave our contact info, as always, in the description of this episode. And if you want to learn more about our company and what we do and who we are, go to sharpercapitalpartners.com, and we'll see you in the next one.